Mr. Weir, it's nice to have you. And I'd love to start off with oil, if I might, given your firm's knowledge of that commodity. The Russians and the Saudis are talking about what might become a 6 million barrel a day cut in production. Do you think that's workable? Do you believe that is something that is actually going to happen?
Well, first of all, thanks very much for this morning. It's great to be here and for me to give you some insights of what we're seeing in the world. Unfortunately, production is not the issue at the moment. It's consumption. We've probably seen, as a result of the lack of transport and lack of air travel, etc., around the world, up to 30 to 35% reduction in oil demand globally. So therefore, let's say it's a 100 million barrel market a year, roughly. That's 35 million barrels. So you don't have to be a genius to do the sums. Basically, an $8 or $10 million production cut, while it's welcome in the long term, is not going to really move the needle.
And that demand conceivably is going to stay low for quite some period of time. What are you doing at Trafigura? My sense would be that physical trading of the commodity is probably quite profitable right now, because while we might see a price on our screen at CNBC that's in the 20s, the real price to buy is obviously far lower than that, isn't it?
Yeah, we do see discounts on the physical part of the market. I mean, our function really is to get sort of product, from producer to consumer in the most efficient manner that we possibly can. And in times like this, what we've got to do is store the oil, basically. The issue is that we're not just seeing demand destruction now. We've been seeing it for a while because obviously, it started off with China. It's moved through Southeast Asia and North Asia, and now it's moved through Europe and now into the US, and the US being the biggest consumer of oil in the world. So what we're doing is effectively, we are buying the crude. We are still selling it, but we're also putting it into storage. The problem is on-land storage is at a very low, it's a very high level. So therefore, there's not a lot of capacity left. And as we keep on having demand destruction, we need to find homes for this oil. So it's either on land or on boats. And so therefore, we are starting to see storage and movement of oil onto ships for storage.
Yeah, is that going to continue? Are there enough ships? Are you buying the ships or leasing ships? Tell us a bit more about whether there's a concern that eventually we run out of storage.
Yeah, no, we effectively charter the ships, but it's going to be a problem. At the end of the day, what we have to do is see production cuts, and significant production cuts. Because unless we do that, we're going to have more and more product coming to the market gets full, and the only thing the market can do as a result of that is the price to go lower. And so therefore, if we can't find storage, we're going to have shut-ins, and it's going to be a real problem for the oil industry.
Where do you think the price would go if we don't get the kind of production cuts you're talking about, which clearly are a lot more than 6 million barrels a day getting taken off the market?
Correct. Well, ultimately, we should see some demand come back, but the question is when and what has to be done in the meantime. But, prices towards, we saw previous lows of $20. We may even have to go lower than that to really force some production cuts, unfortunately. So it's going to be, regardless of, 10 million barrel production cuts can be useful and very helpful, but it's not going to solve the problem in the short term. And I might add, if these production cuts do take place, given the sort of scheduling that you see in our business, it's probably going to take place from May. So therefore, we've got the whole month of April with this additional, if you like, production coming on stream with the lack of consumption in the general marketplace.
Right, which gets back to your point about where to store it all. Mr. Weir, let me ask you about your asset business, because you do own refineries, you own mines as well. One would expect those are not operating at full capacity right now, even if physical trading is doing quite well for you. Are you seeing weakness in that area?
Look, we are seeing, obviously, in the refining business, we've seen refinery run cuts, and that's a problem because we have to respond. Not only, obviously, crude production has to come off, but we're also seeing, product demand is well off, gasoline, jet fuel, etc. So therefore, we are seeing cuts in refineries around the world. It's interesting, though, because in some sectors, what we are also seeing, in the mining, for example, we are seeing production cuts due to the virus issues. So therefore, in the likes of Peru, for example, we're seeing mine production cuts. And so therefore, it's more of a balanced market. So it's not a consistent theme across the entire spectrum of commodities. Whereas in oil, we're seeing massive oversupply. We are seeing oversupply and demand reduction in some other metals. It's not across the board. In some instances, because we're seeing a recovery in China, we might start to see some of these metal prices and demand pick up.
Yeah, I'm curious. Are you starting to see demand for commodities from China again?
Correct. I mean, we've got roughly 25% of our turnover is Chinese or Chinese companies related. And China, while it might represent circa 12 to 13% of oil consumption in the world, it's more like 40 to 50% of, if you like, minerals and metals demand. So therefore, it has a much greater impact and influence, on the marketplace. We are seeing China start to pick back up again. While we saw a huge demand destruction in the month of February, we're probably looking round about being back at 80% of capacity. One of the bellwethers we use for that is, if you like, power consumption. It's around about 80%. Our office is fully staffed in China, and business is coming back. Also, roughly 65% of China GDP is domestically based. So then it's a domestic demand which is fueling this. However, China does also rely on the export market. So therefore, there's a note of caution here. While we're seeing an increase in demand for minerals and metals, and prices potentially increasing, we do rely on the export market. So we may see, if you like, some slight tempering of those more positive views.